keep in mind, all right, we are so far ahead of the retail crowd in this community. This is what 98% of people in crypto right now don't want to put the work in to do to understand the market in which they are involving themselves in. And it's honestly immature on their behalf, but you guys are not part of that crowd. Alrighty, what is going on, everybody? We're just going to do a real quick recap of this week's fundamentals, what's been going on, what we've been discussing and talking about in the CYPRX private community via fundamentals and the outlook for the total cryptocurrency market. Um, Yet again, another accurate week of just very detailed, strategic, logical analysis, nothing hopium or hype-ish, just real insights, knowing what's going on given current market conditions so that way we're not reacting based off of emotions like the rest of the manual retail crowd out there that's just consistently expecting higher prices in crypto when in reality right now, or at least this week as of time of recording this video breakdown, that wasn't to be the case. And I'm not saying that that's not to be the case, as we'll get to that projection towards the end of today's video breakdown, but we had discussed and talked about this week this K33 research report via institutional research report. And one thing that we annotated from this, which I thought was a really great takeaway for the week, was how it talked about CME traders, right? Obviously, of course, people that trade derivatives and ETFs and futures, much more money than you and I. Um, it talked about them maintaining a passive and defensive approach. And so this just goes to support what we do here at CYPRX, and that's play both sides of the market because nobody has a crystal ball. And instead, we deliver both sides of scenarios that could possibly play out, and we understand how to react and adapt to those changing market conditions, right? So showing you guys that that is exactly what we did. We're not going to backtrack the entirety of the week, just looking back at yesterday's PCE prep report. All right, so hopefully you guys are reading this because this, again, could have prepped you for what to expect today without you even having to look over today's market fundamentals. You would have just read this report yesterday, looked at the data today, and been like, oh, we already went over this a day in advance, right? So you can see March 27, 2025, prepping for tomorrow's core PCE. I typed this out for you guys yesterday during Asia session. If we scroll right down here to scenario number 2, you can see I mentioned an inflation surprise to the upside and what that would equate to. So we'll get into that in today's video breakdown. I've also shared throughout the entirety of the week institutional insights from multiple panel discussions, telling you guys about the current market environment and how right now we are in an environment where risk assets like crypto are heavily correlated to other risk assets like equity, stocks, so on and so forth.
And then the vacuum was filled by macro news. And basically, people need something to talk about and something to latch onto. And the crypto market latched onto macro news. And the environment for risk assets has been poor, and crypto just basically moved to exhibit a very, very high correlation with risk assets, but in a high beta manner. So kind of same direction, but going much, much further.
All right. I shared with you guys, I already went over this research report. All right, so just take another look. Here was our Zoom call from March 26th, 2025. Okay, 2 days in advance. And if you go to roughly about 54 minutes into this video, where again, at the end of our discussions, we talk about projections, we give realistic analysis without using any magic indicators or any, things that the retail uses, and it proves accurate almost 99% of the time because we don't overproject things and we just use institutional deltas, liquidity pockets. And so here at roughly about 54 minutes, we were projecting a slight pullback into mid-March lows at roughly around 2.62 trillion. And you can see now today, the total cryptocurrency market cap, I haven't deleted any drawings from that report, that review 2 days ago, and you can see is reflecting that analysis that we gave. All right. So nobody should be confused, especially if you've been paying attention to what we've been going over thus far. So that leads us to today's report. I'll drop this for you guys in the chat so you can thoroughly read through it on your own time after today's call. And this is going to cover current market conditions, going over why we're seeing sell pressure on risk assets intraday. And then we'll deliver a perspective towards the end of this of what we need to see the market sentiment improve and to see higher prices, or at least us hold above March lows where we're currently trading. So in recent weeks, several macroeconomic and geopolitical factors have converged to pressure risk assets such as cryptocurrencies. Keep in mind, all right, we are so far ahead of the retail crowd in this community. This is what 98% of people in crypto right now don't want to put the work in to do to understand the market in which they are involving themselves in. And it's honestly immature on their behalf, but you guys are not part of that crowd. As you all can see throughout the entirety of the week, I'm sure that you guys, if you're still watching YouTube and Twitter at this point, you could see it across the board. Nobody's talking about this stuff. Everybody's really only talking about the positive fundamentals that are retail surface level things. And I get that, completely understand that it keeps you hopeful, keeps you forward looking. But if you're trying to make money in this space, that's not really what matters right now. All right. And so, yet again, we're just proving accuracy with the analysis and trying to teach you guys the proper way to analyze not only these fundamentals, but how they apply to changing market conditions, whether they make the market risk on or risk off. So, our prior analysis suggested that sticky inflation, tariff uncertainties, a hawkish Bank of Japan pivot, and rising demand for safe havens like gold and the Japanese yen could fuel outflows from high beta assets. Here is that Zoom call from around 53 minutes and 30 seconds on March 26th, where we discussed this scenario. You can see that screenshot there. We also dropped this for you guys in the chat where this lady from Signum talks about this heavy correlation between risk assets such as crypto and equities in the current market environment and how right now those things are temporary. We'll get to that in just a second and how those conditions could change. And then again, obviously, here is today's price action, just to reiterate. So that view has largely played out, which was the view that we gave back a couple of days ago in our previous Zoom analysis. With the total cryptocurrency market cap shedding more than $100 billion as of time of recording amid mounting market uncertainty. If we go look at the total cryptocurrency market cap, right now we're down about 125 billion on the day. Below is a recap of the key developments influencing market sentiment. Number one, sticky inflation and negative equity markets reaction. I covered this one first because this goes hand in hand with our PCE prep from yesterday. So in our prep from yesterday, just looking at some of the highlights, again, here's that prep from March 27th, a day in advance, always giving the private community members these insights before they come out. This is the type of community you want to be a part of because you already knew after the data came out today what was most likely going to be reflected in price action. Okay. We talked about inflation surprising to the upside, higher than expected readings, would most likely lead to any surprise weighing on risk assets. The market is aware these February numbers may not fully capture upcoming tariff-driven price increases, so any upside surprises will intensify anxiety over what further inflation prints could look like in spring and summer. And we discussed and talked about these scenarios weighing on risk assets, and we can see that reflected in price action today. So the core PCE upside surprise. The Federal Reserve's preferred inflation gauge, or core PCE, came in at 0.4% month over month versus a 0.3% consensus and a 2.8% year over year versus 2.7% as expected. These hotter than expected readings align most closely with our more pessimistic scenarios, which we discussed scenario 2 or scenario 3 from our previous reports. And I want you guys to look at the actual data, right? So 0.4 month over month and 2.8% year over year. If you go and you look at our projections, look at this. What did we say a day in advance? 0.4% month over month and 2.8% year over year would weigh on risk assets, right? We literally gave you guys this word for word, and that's how the data actually came out today. And we can see it negatively impacting price, right? So prepping you guys, that's why I try to type these preps out in advance so you understand everything that could possibly unfold, taking a passive and defensive approach, right? Moving on. Fed constraints. With inflation still running high, the Federal Reserve remains constrained in how much it can ease monetary policy. This dampens risk sentiment as markets had been looking for possible rate cuts or more accommodative stances in the near future. The S&P 500 and Dow each slid about 2% on Friday, while the tech-heavy Nasdaq dropped 2.8%, with large-cap tech stocks such as Apple, Amazon, Google, and Microsoft all down over 2%. Investors rotated into safe havens, notably gold and bonds, as yields on treasuries fell. And in this previous call, which we also made public, we discussed and talked about this inverse correlation between safe havens like the Japanese yen and gold and went into that in detail, right? So just to show you guys another reflection, you can see, just looking at the inverse correlation, we're still seeing this right now, very correlated, right? So gold has significantly increased from Thursday, March 27th and has touched and revisited new all-time highs. And you can see Thursday, March 27th, in the total cryptocurrency market is exactly when we created this intraday top at 2.8 trillion and started to make our way down to where we're currently trading at now, right? Tariff uncertainty and heightened trade tensions. Today, President Trump pushed to implement auto tariffs, or sorry, excuse me, I don't know if this was today, but over the last, let's just say 48 hours, which are set to begin on April 2nd. And potential further reciprocal tariffs have roiled markets. Major automakers like Hyundai, BMW, Mercedes-Benz, and General Motors all experienced declines on fears of escalating trade wars. According to market sources, foreign and institutional investors have recently withdrawn about $6 billion from U.S. equities, one of the largest weekly outflows on record, signaling a broader flight from risk and tariff-related uncertainty. Cryptocurrencies, including Bitcoin, often trade in close correlation with tech-heavy indices, which we already went over. So again, outflows of equities, risk-off market environments tend to reflect itself currently in crypto prices. And again, here's a resource for you guys to tap into if you want to hear a little bit more about that. We also had hawkish Bank of Japan. Japanese yen demand, Tokyo's consumer inflation data came in higher than anticipated, further fueling expectations of the Bank of Japan may take a more hawkish stance in times of rising inflation and trade uncertainty. The yen's safe haven status increased, prompting additional capital to rotate out of risk assets like crypto and into the Japanese yen. And again, we went over that extensively in previous video breakdowns and in fundamental reports, where we delivered our synopsis of what could happen if we saw a stronger Japanese yen or a more hawkish tone from Japanese finance ministers or Bank of Japan speakers, right? You can see a screenshot reflected in this in some of the fundamentals. It highlights risk-off environments, risk-off mood, further strengthening saving flows into the Japanese yen. And you can see another key vocab right there, hawkish. We also had growing stagflation and recessionary concerns. Hot inflation, weakened consumer spending, and an uncertain labor market outlook are amplifying fears of stagflation. Defined by slow or negative growth coupled with persistent inflation, this scenario tends to heighten recession risk and boost safe haven demand, thereby adding further sell pressure to equities and cryptocurrencies. Consumer sentiment fell over the third straight month, dropping 12% from February and 28% from the year earlier. Higher inflation expectations up to 5% from 4.3% in the previous survey reinforced the notion that consumers feel the pinch of rising prices and may curb spending going forward. Now, I wanted to incorporate this little screenshot of this fundamental piece in here, and I want to pay attention to key dates here. So it says consumer sentiment took a dive in March as concerns about rising prices and slowing economic performance hit home for U.S. households. And it talks about how this marked the highest reading since 2022, as well as 3 months of expectations increases that Michigan posted, blah, blah, blah. So anyways, it talks about 2022. And in this Signum report, okay, keep in mind what the Signum rep said about how institutions are not selling their long-term holdings.
That they're actively exploring ways of how they can purchase Bitcoin in budget neutral ways. Then we also have institutional adoption, really proceeding. And here I would like to make the point that, the Bitcoin ETF inflows and outflows, I think, have confused people and definitely affected sentiment negatively. But when we look at the period of outflows and then the period of inflows, and we overlay it with futures trades of hedge funds, there is data on this, then we can kind of dissect whether it was market neutral transactions or whether it was actual institutional buying or institutional selling. And the evidence is that when we saw a lot of outflows, that was overwhelmingly closing market neutral arbitrage positions. So rather than institutions selling their Bitcoin holdings, and recently closing market neutral arbitrage positions. So rather than institutions selling their Bitcoin holdings. And recently when we have seen inflows, that was primarily outright buying.
Even though the sentiment is worse now than it was back in 2022.
Very significant amount of crypto, and that selling was selling pressure and all of this. So there were some disappointments and some negative developments, but ultimately what we saw was that it affected sentiment, and then sentiment took on a life of its own. And actually sentiment ended up decoupling from fundamentals to an almost unprecedented extent. actually the crypto fear and greed index, which is kind of a measure of market sentiment, was lower recently than in the wake of FTX. And that's crazy. That's crazy. In the wake of FTX, the fundamentals were very poor. Institutions were walking away. The market just had a ton of scandals and scams and fraud, and regulators were very much cracking down, and in a, not in a helpful way, not in a let's clean things up, but basically just preventing innovation and preventing business. The political headwinds were very real. It was crypto businesses were getting debanked. It was very hard to get going and to actually build anything in the crypto space. And these truly negative fundamentals justified a better sentiment or a less terrible sentiment than what we saw quite recently. And this gap between the actual fundamentals of political and regulatory support, move on reserves, institutional adoption, all of that going forward is glaring. And I think it really could just happen because the post-election euphoria disappointments just basically left the market without a narrative. They left the market kind of rudderless.
She talks about in this detailed panel that institutions are switching up their arbitrage positions and their leverage positions and their trading positions and not their long-term holdings. That's important, okay? In my personal opinion, because it kind of just paints a picture to solidify what she says at the very beginning of the call, that right now we have seen the most bullish fundamentals in crypto history that we have ever seen in the last 6 to 8 months.
Yes, certainly. And I would go even further than calling it good news. I would say that crypto fundamentals have never looked so good.
More bullish than we've seen over the last 5 years of developments. It's just that right now the sentiment is risk off due to all of the uncertainty that's lingering in the market, right? And she talks about institutions and how they're positioning themselves in detail. And she talks about how institutions are still seeing as majority buyers when the market sentiment shifts around. They're not selling their long-term holdings and they're just shifting around arbitrage positions, right? That's important. So talking about gold prices real fast, they've climbed above the $3,086 per troy ounce mark, bolstered by geopolitical uncertainties and persistent inflation concerns. Now, some fair value models suggest gold could be as much as 13% overvalued, indicating that the market has already priced in significant policy and geopolitical risk. That's something to keep in mind. For example, if uncertainty continues to linger, you can kind of see this in gold's price action right now. If we go just take a look at gold real quick. And we go like, let's say down to the hourly time frames a little bit clearer. Okay. So you can see here how gold has tested its current all-time high of roughly around $3,086 per ounce once, twice, and now 3 times currently where we're trading at now. So the question is are we going to see continued escalating tensions and concerns, creating more demand for safe haven, fueling this gold rally higher? Or are we going to start to see easing conditions, possible positive news as we head closer towards April 2nd and start to see profit taking on gold, which could potentially lead back into risk assets, right? So that's why I incorporated this in today's report. Just keep in mind that, some analysts are warning that gold could possibly be already at a premium, and that anything that does not escalate or drive fear, uncertainty, and doubt forward or create new, fresh headlines, uncertainty, and doubt, we could start to see some profit taking. That's just important to pay attention to. Any positive developments. So now let's start to talk about upcoming events and scenarios. Any positive developments that ease market anxieties, be it a resolution or de-escalation of trade disputes, a peace initiative in Ukraine, that's important as we head into the weekend, or cooler inflation data could spark a relief rally in equities and crypto. A pullback in gold and safe haven flows would likely also coincide with this event. So coming up, this is what we need to be paying attention to next week. So things to just be mindful of. The April 2nd deadline for these tariff developments. Right now, the market is expecting more details on auto tariffs and reciprocal tariffs on April 2nd. This date is viewed by some as a potential turning point, But many analysts believe uncertainty could intensify if U.S. trading partners retaliate. So right now, what I'm expecting is for Trump to come out and say things that ease recessionary, or sorry, excuse me, tariff fears and implications, dialing some of those uncertainties back. But then what I'll be paying attention to in April is any reciprocal tariffs announcements from any major jurisdictions as of right now. It's kind of what I'm seeing play out. Trump comes out, dials uncertainty back, market has a little relief rally, and then after that, we need to really be paying attention to do any of these tariffs that take place, we see any jurisdictions escalate things further, create reciprocal tariffs, so on and so forth. All right. Next week, we have PMI surveys. Chicago PMI, final manufacturing PMI, and ISM manufacturing services PMI. So any significant deterioration could fuel recession fears and further dampen risk sentiment. So we will be paying attention to that. We also have, which I personally think is going to be the key focus next week, is going to be the ADP non-farm employment change, weekly unemployment claims, and the official non-farm payrolls, along with the unemployment rates. So I think that next week's focus is going to be key U.S. labor market data, but that's just, again, yet to be determined. Weak readings may heighten growth concerns and weigh on risk assets. So anything in the terms of labor market figures next week that spark recessionary fears or feed into that narrative would most likely weigh on risk assets and fuel demand for safe havens further. While on the flip side, any stronger employment could help heal near-term recessionary worries. And then we also have Fed Chair Jerome Powell's speech on April 4th. So we'll be looking for any guidance on inflation and monetary policy, along with any, economic implications that could stem from these tariffs. All right. And then obviously, of course, I personally don't think he will mention anything about rates. He'll probably just reiterate his same stance, but any indication that rates could be delayed longer than anticipated could definitely put more pressure on risk assets as well. All right. So overall, the near-term market environment remains right now, intraday as of time of recording this video breakdown, risk off, driven by sticky inflation, aggressive tariff stances from the US, weakening consumer sentiment, and renewed demand for safe haven flows into gold and the yen. Right now, the total cryptocurrency market cap, though still above March lows, has lost considerable value this week. Given the looming tariff headlines, upcoming labor market figures, and potential shifts in Fed rhetoric, volatility is likely to persist. So again, I wanted to end this fundamental piece with this, keeping in mind that we are still bullish. I'm personally still bullish, right? I'm still stacking blue chip digital assets that I think are going to perform well in the future, but I'm under the assumption as well that the market could continue to deteriorate worse if sentiment continues to increase demand for safe haven, right? We continue to see geopolitical tensions. For example, let's say this weekend comes out and some major announcement that Russia and Ukraine are not going to solidify a peace agreement that could spark fresh fear, uncertainty, and doubt in the market. Just things of that nature, right? Things that we've been covering. Anything that creates more demand for safe haven, we have to understand, no matter how bullish the fundamentals are for crypto underlying right now on the infrastructure side of things, are that crypto is heavily correlated right now to other risk asset classes. And so, we just need to continue to be mindful of that. So if the data worsens, recession fears will likely intensify, pushing investors further into safe havens. And then conversely, any easing of trade tensions or peace deals and geopolitical tensions, or any data that eases recession fears, will most likely be the factors that lead to profit taking on safe haven and more support for risk assets. Until then, caution reigns as heightened trade risks and stagflation concerns keep pressure on crypto and other assets. And I just leave you guys with some of these fundamental panel discussions to watch throughout the weekend if you haven't already. Some really good insights here just to paint you more a short-term projection and also long-term projection as well. So, in a nutshell, after today's report and after everything that we discussed this week, you guys should not be confused on why the market looks the way that it does. All right. So, just giving my personal perspective before I let the floor open up for questions and open commentary. Again, what I'm seeing on the higher time frame, daily and above, looking at the total cryptocurrency market cap, is yes, we're seeing some sell pressure, we're seeing some profit taking, and we're still seeing sellers predominantly in control, buyers unable to completely take out previous sellers in the market, i.e., from the beginning of March after the Trump crypto reserve announcement, when the market, fake rallied up into $3 trillion and since then has declined. We made a nice slow grind back up into 2.74 trillion, but we're still seeing some market uncertainty linger. However, that market uncertainty is not enough to completely outweigh all of the buyers here in this area for now. All right. So that means that gives me hope that if conditions can improve, if we can see some positive fundamental developments, if we can see the positive side of today's report unfold next week, then rolling into April, maybe we can see April hold above March lows and we can start to chug back away to the upside. Whether that's we see price hold at 2.62 trillion and rekindle losses, or we see a dip down into March lows at $2.4 trillion and we rekindle losses. If we can see an improvement in market sentiment heading into April, for example, tariffs aren't hitting the market as bad, creating market uncertainty. We see labor market data that eases recessionary fears. We see Fed speakers throughout March that hint at a more accommodative monetary policy stance coming up in the near future. Um, things of that nature, right? Things that create a supportive risk on environment, then we can see scenarios like this and we can continue to project a slow chug away of recovery at the recent sell-off that we've seen from March and February, right? Inversely, again, we have to be adaptive and reactive. If conditions continue to worsen, we do not see buyers overpower sellers and break into new highs or overcome these previous sell premiums or where sellers were engulfing buyers, then we have to assume that the overall trajectory that I previously analyzed of a full correction of this November to December move is most likely still to be the case. We're probably going to break down below 2.45 trillion and probably end somewhere around 2.2 to $2 trillion, correcting more of this previous bullish move. So just be prepared for that as we roll into April as a possibility if market conditions worsen, right? Again, we just have to play the week by week, data by data, continue to prep you guys like we have been in advance. So that way, when the time comes, we can react to any narrative that the market throws at us. All right. Outside of that, that's the fundamental breakdown today. You guys are now well aware of why the market's down over $100 billion. Try not to be distracted from the mainstream resources. Do your own research, read into the fundamental documents that we have to share in this chat, and watch the panel discussions. You will learn so much more than paying attention to what's on YouTube and Twitter, right? Outside of that, that's all I got for you guys. I'll leave the floor open for questions for a bit, open commentary. If you guys want to talk about what you think is going to happen, I'm more than willing to hear your opinions. I'll let the floor breathe for 5 or 10 minutes. If you guys have anything.